Hi, I'm Gordon Lamphere with the Real Finance Podcast, the podcast series where we interview key entrepreneurs, scientists, and activists shaping the real estate industry and, as a result, our world. On today's podcast, we'll be speaking with Fernando Angelucci. On the podcast, we learn what it's like to be a self-storage renaissance man. Fernando walks us through self-storage deal-making, his investment theses, and why self-storage is one of the most recession-proof real estate investments. It's well worth a listen. Hey, Fernando, thanks for hopping on the podcast today.
Yeah, thanks for having me, Gordon.
So could you tell me a little bit about yourself for any of our viewers that might not know you?
Yeah, so son of an immigrant, came to the United States basically with the American dream. So they wanted that I, go to school, get good grades, retire at the same company after 40 years and, take a pension type thing. When I was 16, that all changed. I read Rich Dad, Poor Dad. And then from there, my real estate journey continued. I did get a degree in ag bioengineering, but then shortly after there, I started investing in single family and then multifamily. And then ultimately now I focus 100% of my time on self-storage.
So we're a company that was founded by folks with that same immigrant mentality, 140 years back. Why commercial real estate? There are a lot of folks that come in and have that push to succeed. Why did you choose commercial real estate as that venue?
Yeah, so I found that commercial real estate is one of the easier avenues for financial freedom, especially when you're comparing it to other types of real estate. So, for example, residential, it was like pulling teeth trying to get $50,000 to $150,000 loans. Trying to raise capital for that was even more difficult, and it was hard to scale our business. But once we switched over to self-storage, our business basically took off. In the last 4.5 years, we've done $220 million worth of storage. And it really is easier when you start adding zeros onto your deals. And then, inside of commercial real estate, the self-storage space specifically, I really like because it is non-habitation based real estate. So no one's living inside of my asset or my investment. I don't have to go through evictions. So it's just a much easier way to financial freedom.
So yeah, that is a deeply unique thing that I think most people don't always understand about real estate is that sometimes bigger deals are actually easier than smaller deals. That was something I certainly learned, and I'm a fourth generation broker and developer. One of the things I'm curious though about that is why particularly self-storage? Because look, there's a lot of asset classes, even the commercial world. And look, I do not do residential real estate. I'm a proud referrer of many real estate deals over the years. And there are plenty of residential agents in our area that have got to profit from that. But why self-storage in particular? Because that seems like an asset class that a lot of folks aren't particularly familiar with.
Yeah, so there's a few reasons. So I'm an engineer by training, so numbers-based guy. So what I did was I looked over the last maybe 40, 45 years and compared self-storage to different real estate assets. And what I found is, there was this study done by the National Association of Real Estate Investment Trusts, and it was a study period over roughly, 30, 35 years. And during that time, the average annual return of the S&P 500 was 7.5%, 8%. Multifamily and residential did a little bit better at about 13% return. But self-storage came in at a whopping 17.5% average annual return. So that, that 4.5% may not seem like a lot, but, compounding interest is one of the miracles of the world. So if you had $100,000 to invest at the beginning of the study period, the S&P would have turned around about 500,000. Apartments and residential would turn around about 1.7, 1.8 million. But in storage, you would have gotten about $4.1 million back. So over twice your return that would come back just because of that extra, 4% compounding. So then people say, okay, well, if it's a high return, that must mean it has, a high risk piece to it as well. And what we found is actually the opposite based on the data. So self-storage provides a very asymmetric risk return profile. So if you look at the last two, tough recessions that are on recent memory, you have, the 07, 09 financial crisis where the S&P 500 dropped like 22%. I knew a lot of investors that they completely lost their shirts on residential and multifamily properties. From that same study, the National Association of Real Estate Investment Trusts, they found that self-storage dropped only about 3.5 to 3.8% in value during that time. Now, we can fast forward to something a little bit more recent, which would be the pandemic. So according to TREP, which is a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage investors in the first 3 quarters after the pandemic went into full shutdown mode, there was only 3 that were over 30 days delinquent. So that's a 0.17% delinquency rate. During that same period of time, multifamily was defaulting at a rate of 1,800%, or 18 times the default rate of self-storage. So as you can see, it does fairly well, and they call it a recession resilient asset. And the data over the last 5 or 6 cycles has proven that. So those are kind of the numbers reasons. But then the headache reasons of why I got into self-storage was because, being a Midwesterner, living in Chicago, I first started buying residential properties in, more challenging neighborhoods, C and D neighborhoods, just because I was chasing yield. And the eviction process that I had to go through on some of these properties were just so ridiculous.
I can imagine.
I mean, doing everything right, and it still take me 8 months to get out a tenant that hasn't paid once since we bought the building. And then when they leave, they cost like $25,000 in damages from, pouring quickset concrete down the plumbing. There's none of that in storage. In storage, instead of it being tenant landlord law, it is property law or lien law. So the second you put your possessions inside of one of my facilities, you're de facto giving me a lien against your possessions. And if you don't pay, I overlock your unit first. And then if you still don't pay within 30 to 45 days after being overlocked, then we auction off your possessions. And usually we'll have a tenant right in line ready to enter the unit as soon as the current unit is cleaned out. It's all made out of steel and concrete, so there's not really any damage you can do. Everything is access controlled. So if you haven't even paid your rent, if you're late on your rent payments, you're not even allowed to get into the self-storage facility to do any damage, right? So much more safety as far as, the rights that are afforded to us as owners and developers of these properties, as well as the risk return profile.
Look, I think that's something as an investor who's had, even in the commercial space, we're talking, small industrial office has seen absolute horror stories over the years. I'm curious, particularly though, I understand some of the legal concepts. I'm a JD, but the thing that really makes me curious about the asset class is, why haven't large venture funds really come into the asset class and dominate it if you get the same rate of return? I know for us, we're starting to see pretty large funds come into like Class B and C industrial, less so than many of the other asset classes because of the level of friction, and we can talk about that. But what makes self-storage so unique in terms of that rate of return? And maybe that's a too difficult question, but I'm just very, very curious.
Yeah, so that's actually what is happening right now. You're seeing a ton of money being pumped into our industry over the last, call it 10 or so years. Self-storage used to be kind of that ugly, stepchild that nobody wanted to talk to. And if you weren't buying a 15% cap rate day one, it wasn't a good deal. But then all of a sudden, all these real estate investment trusts, these private equity companies, hedge funds started to see the risk return profile and started aggressively pursuing this space. They still have a long ways to go before they dominate the market. There was a study that was done in 2018 that looked at the fragmented market of self-storage. So at the time, they said there was roughly 52 to 55,000 self-storage facilities. That number has now gotten up to between 60 and 70,000, depending on which research you look at. And the industry ownership is broken down in a way that shows a lot of opportunity for aggregation and roll-ups, which is one of the things that we do. So about 18 to 20% of all the facilities in the United States are owned by the 6 largest publicly traded real estate investment trusts. You know their names, you know their colors, you see them all over the place. The next 9 to 10% of the facilities owned in the United States are owned by the next 100 largest operator, which I'm a part of, right? That means that there's over 70% of the entire space that is still owned by mom and pop operators. So if you look at the way that we do business, we kind of try to take advantage of each one of these pieces as being kind of a portion in the feeding chain, if you will. So we go out to these mom and pops, we buy their facilities, we do value add and turnaround, maybe even some expansion. Then we aggregate those into larger portfolios of 10 to 20 properties. And then we sell them to the second level aggregators that now they're, putting together portfolios of 50 to 100, 200 properties, and then selling them to the top 6 publicly traded real estate investment trusts. So that was one avenue of our vertical. But then what we noticed very quickly, and this is some of the friction that why you're not seeing the kind of institutional money really taking over the space very quickly, is that unlike a multifamily property where you can build a $500 million property because it just keeps adding units and units and units, you can't really do that with self-storage. So on the mom and pop side, you have facilities that are anywhere between 10 to 50,000 square feet. The second you cross over 50,000, then all of a sudden you start to see the cap rates drop by almost half, because now they're a large enough transaction that publicly traded company or institutional based investor is willing to spend the time and do the due diligence on, because it makes sense. So what we noticed is cap rates went from 8-9% in that mom and pop space all the way down to 4 to 5% as soon as we crossed over into the institutional territory. So I said, well, we can't, the goal is to have an 8 million square foot, between 8 million and 9 million square foot portfolio. So I said, we can't get to that number buying these 20,000 square foot facilities, but we can't afford to buy the ones that are larger. So we're going to have to build them. And so that's when we opened up our development arm, where we build these class A REIT grade institutional self-storage facilities that are between 80 and 120,000 net rentable square feet. And then those can also be aggregated into larger portfolios and sold up into some of the top 20 operators will be interested in buying those types of things. So that was kind of the second vertical of our business. And then when COVID hit, there was a lot of issues with supply chain. If you could even get the product, what was the price going to be? So we saw things like steel go up almost 500%. And then we saw
crazy time.
It was nuts. And if you could even get the steel, then you had these wait times that were almost ridiculous. I mean, 8 to 18 months, depending on what type of materials you're trying to get. So that's when we created our third vertical, which was going after these big box retail stores that had gone dormant, and actually converting those using an adaptive reuse conversion into Class A storage. So those are the 3 main verticals that we have. And the only area that you're really seeing kind of the institutional private equity hedge fund guys coming in is they're playing at the very top end of that market, where, if the property is less than $20 million, they're really not interested in it.
Yeah, that's something we've seen very similar in the kind of the Class B and C industrial world. That's somewhere where we've made a lot of money over the years. In terms of going and taking a look at some of the developments you've done, and I'm definitely going to follow up on the adaptive reuse cases, but. And I know, we always on the podcast want to tiptoe around anything that's proprietary, but
Sure.
What do you see in terms of an ideal deal that you're looking at when you're looking at either doing a development or you're looking at a redevelopment? Are there certain metrics that particularly stand out to you as a great self-storage investment?
Yeah. So, number one will be demographics drive everything. This is real estate. So location, location, location. It doesn't matter what type of asset class you're in real estate, the location is the number one. So, right now we're doing, I think, just looking at my pipeline last week at our all hands on deck call, we had about 140 million in the pipeline of just developments. And people are saying, well, Fernando, you're crazy to do developments when I see all these articles of, imminent recession coming in. But you got to remember, self-storage is a recession resilient asset, and it operates really well, especially in locations that are benefiting from recession. So for example, the Southeast, we have 7 projects right now between the Tampa and Orlando corridor where people are moving there in droves. Home builders can't even put up homes fast enough. So all the same things that would make sense for a multifamily or even a retail location is what we look for self-storage. High traffic counts and visibility. I want to be next to a dense residential, right, where my customer's coming from. And then I want to be in an area that has an increasing and diverse population and job growth market. So um, the interesting thing about self-storage is that it's a hyper localized business. Typically, you're getting anywhere between 65 to 90% of your customer base is coming from a 3 to 5 mile radius, or roughly a 5 to 15-minute drive time from your facility. So when you're looking at markets, you have to look at super drilled down local markets. You can't say, hey, Chicago's great or Tampa's great. You can't even say, the west side of Chicago is great or the east side of Tampa is great. You really have to drill down and look at what is the supply and demand in that area, and can they absorb new units as they're coming in. So that's what I'm usually looking at for when I'm building a facility or doing an adaptive reuse conversion of a big box retail store. I'm going to be doing some secret shopping of the competitors, making sure that they're all at stabilization or better. In our industry, 90% occupancy is considered good stabilization. If you're above that, that means that you're not pushing rents high enough. If you're below that, either your rents are too high or you have oversupplied that market.
Yeah. So, in terms of that, when you're looking for adaptive reuse, I'm curious what you're looking for. So, we get calls on every once in a while, we'll have large industrial properties come available, and we get calls of people asking. And I'd say, self storage is probably one of the higher, um, at least, in terms of volume that we get calls based on that. Uh, what's a good building or property that's conducive towards effective adaptive reuse, or is it just a number of factors that I can't even imagine off the top of my head?
Yeah, I mean, you can have kind of a back of the napkin type math or rule of thumb. So typically for my type of redevelopment, I usually don't want to go into these projects unless I can put up at least an institutional grade amount of storage. So I'm always thinking with the exit in mind. Our goal is to get to a 10-figure exit in 10 years to one of these top, 8 or 10 publicly traded companies. So I'm not going to look at any facilities that I can't at least get 65,000 net rentable square feet. And our typical efficiency based on, locations of pillars and the layout of the box or the envelope is anywhere between 73 to 78%. So if I need to get 65,000 net rentable, I'm looking at big box stores that are at least 85,000 gross square feet, if not better. I'm looking for things that have really good bones. So, Sears buildings are a perfect example of that. Walmarts are a really good example of that. Old grocery stores as well. I'm typically staying away from the businesses that really were known to beat up their facilities. So, Kmart's are a perfect example. And every time we walked to Kmart, everything was completely shot. The roof was bad. All the MEP was bad. It really just didn't make sense for us. And then on the demographic side, again, the nice part is these buildings were already located in areas that work for self-storage, right? They're typically around dense residential that has high median incomes, that are on major thoroughfares, they have high traffic counts and visibility because they're retail. They need these things. And all of that does well for self-storage as well. Other than that, depending on the pricing, I will also look at clear heights. So, typically we're buying these buildings at anywhere between $8 to $20 a foot, but there are other sellers out there that are trying to get almost double that for these vacant boxes. And I'm willing to do that if I can get a mezzanine level placed in. So like I was saying before, I need a building that's got, call it 85 to 90,000 gross square feet. But let's say it doesn't have that. Maybe it's only 50,000 gross square feet. However, the clear heights are 24 feet to the rafters. That allows me to come in with a mezzanine level and literally build a second floor inside of that single story building, which allows me to double my footprint and make the metrics work, both from a financial standpoint, but also from a size when it comes to exiting this Class A asset to an institutional player.
So you've mentioned exit over and over again. And I think we want to come back to that. But before we get to that point, how do you end up leasing these spaces up? Is it predominantly web advertising? Is it boots on the ground? How do you go through and do it? Because look, there's a lot of ways that we do it on the commercial side, reaching
Right.
B2B. How are you reaching business to consumer?
Right. So, I think it's a mix between your actual marketing campaigns and then also the type of people you hire. So we're a little bit different where when we're hiring a property manager, the actual sales, the profile we're looking for is really a salesperson because we want them to get people in, convert, and based on how the marketing's doing, and then upsell. So even though all of our facilities are built to be run completely remotely, typically on the lease up, we'll have 1 to 2 full-time sales guys going in and really pushing. So not only are they doing sales, grassroots marketing, going out and creating partnerships with apartment buildings, pizza companies, assisted living facilities, and saying, hey, you send people our way, we'll cut you an Amazon gift card or some type of bonus for that. But then they're also they have to convert on the paid marketing that we're doing, which is going to be your SEO, your PPC, going on aggregator websites like Sparefoot. Um, but the biggest thing, again, even though we're in an information age, the majority of your customers, when you ask them why they chose your facility, is because they saw it either on their way home or on their way to work. So that's why visibility is so important. So one of the things, I know you're talking about the industrial side of the world, for us, we've been brought a lot of industrial properties to convert, but the problem is they're hidden back in these industrial parks that no consumer would ever be driving past, only people that work in the industrial park. So we always will pass on those types of deals. So with us, we're putting in a pretty hefty marketing budget on a monthly spend basis in the lease up period. But once we get to, call it 90% occupancy, we can really we can kind of take our foot off of the gas pedal on the marketing costs, and the rest of it is really kind of uh, organic marketing that comes in.
Hey, that makes a lot of sense. In the it's a crazy world where I think we do digital marketing probably better than anybody else in our area, and I still say probably 35 to 40% of our business comes in from signage alone. So
Right.
that does not surprise me. In terms of moving forward, and I wanted to follow up on the exit. So, what does an exit look like? I know you're syndicating deals and you're putting deals together and you're leasing them up and things look great on paper. But what is an exit look like compared to somebody who might just be a lease and hold kind of investor?
Yeah, so I've run the numbers on the lease and hold. The problem with that is because we're forcing so much equity into these deals, that model doesn't really make sense from the kind of the long view. So yes, I'm always going to have properties that I will hold kind of in my retirement portfolio that it's pick them off as I go, where I don't need to bring in any debt. I don't need to bring any investors. I'll just hold those cash as retirement money. But the majority of the deals I do, I bring in accredited investors, family offices to get those done. And they want a return on their capital as fast as possible. They want that velocity of money. So typically what we do is you have two styles of investors. You have the investors that are willing to take, risks, go into more opportunistic style investments. And then you have another type of investor that are more just kind of coupon clippers. They want to invest, then they just want to get their, 5% cash on cash return, every year, 6%, what have you. So what we do is we will typically use for any type of adaptive reuse, ground up development, or heavy value add, we'll go with those more opportunistic style investors that want a higher yield to take on that risk. And then the second we have that that facility stabilized and it's reached peak value, then we'll actually move it into a separate fund that is just income based. It can be a DST structure, it can be just a pure income play, because the goal is to get to that critical mass that we can exit and get a really good cap rate compression based off of the size of the portfolio. So we're getting a premium on size. You can't keep selling your assets, right? I mean, this just came out in the news. We're here in May. This happened in April, but Public Storage, the number one publicly traded REIT, made an offer to buy Life Storage, and the offer was too low. And then Extra Space, which was also, so Life Storage, Extra Space, and Public are all in the top six. Extra Space saw the opportunity and they came in and they actually bought out Life Storage for $12.7 billion. So they came in and so you're seeing this further aggregation that we're talking about at the beginning of the podcast. So to get that type of multiple, you need to have a good critical mass. And I think at about 80 to 90 Class A, pretty homogenous facilities, I'd be able to exit to one of those top six players at a pretty good multiple above what the actual facilities are worth themselves because of that premium that's given to a larger portfolio size.
So, look, we've discussed exits and we've discussed what's happening right now. I think the biggest thing that's happening right now that everyone's talking about in the real estate space is the high interest rate environment. So I know this podcast is going to come out probably 2 weeks from now, but I think we're still going to be in a high interest rate period. How has high interest rates changed the deal making process, or has it changed it at all?
It's so interesting that you use the word high interest rates because we're still historically at some of the lowest interest rates we've had in this entire country in the last 100 years. So
Yeah,
it's
of course.
actually returning to normal interest rates, not going to high interest rates. You want to talk about high interest rates, we can talk about the 80s, Paul Volcker years, or when we had 18%. So during the 80s, during the Paul Volcker years, if people are really convinced by this high interest, I'm using that in air quotes, high interest rate, that it changes deals, slows down deals, it doesn't. I mean, to say that real estate stopped, there was investment in real estate and development stopped in the 80s is ludicrous, right? So the thing that I think is important are kind of twofold. Number one is interest rates don't matter. All that matters is what is your real rate. So interest rate versus your inflation rate. And today, May of 2023, we are still able to borrow at a rate lower than inflation, which means we're literally getting paid to borrow money. So that's the thing that people just need to be putting into perspective because they talk about interest rate, but they never talk about the other piece of the story. So hoarding cash right now is dumb because your cash is being eaten away, purchasing power is eaten away by inflation when you can go out and borrow for literally free, right? The second piece is, yes, the higher interest rates have squeezed debt service requirements, which I see as a good thing. In the last 10 years, not only in my industry, but in all real estate assets, a lot of people that had no business being in the business, if you will, they are now getting pushed out because they don't know how to do deals. They don't know how to structure deals. They're trying to come in with super high leverage. And that worked for a little bit just because the market winds were behind them. But now we're returning to reality, and you can't be this, gunslinging, shooting from the hip, deals will work out the longer we hold on to them type investor, right? So it's been fantastic for us. Our deal flow has increased substantially as interest rates has increased because now we're competing against less people. And the way that we're able to get deal done is twofold. One is obviously using appropriate leverage so that our debt service requirements are in check. The second piece is going back to kind of the forgotten art of creative financing and creative deal structuring. Seller financing and assumptions of mortgage, that was such a common thing in the 80s and early 90s. And it seems like people forgot how to do them just because you can go to the bank and get a sub 3% mortgage, right? So we have a lot of deals now that we're structuring very creatively with sellers where they're carrying the paper for us at rates that are half of what we get from banks. Sellers still want their pricing. And the unfortunate part when you're in a high velocity market where interest rates are changing so fast is that typically buyers are 12 months in the future and sellers are 12 months in the past. So right now, sellers are saying, well, a broker told me my facility was worth X 12, 18 months ago. And I said, it's worth X 12, 18 months ago when I had financing that was Y 12, 18 months ago. So what I can do is you're not going to sell this thing unless you come down to my price, or I'm willing to go to your price if you offer me the type of financing that was available to me when your facility was valued at this number. Because a lot of people, that's another piece they forget, is that they're so fixated on cap rate and on purchase price. And that really doesn't matter, because what matters is you have the other side of the equation, which is the financing piece. Call it a 5% rate on a 25-year AM, you're paying twice. You're basically buying your asset twice. You're buying it for its actual purchase price, and then you're paying the entire purchase price again in interest over that period. So what I'd rather do is say, hey, listen, Mr. Seller, you're asking for a price that's 20% above what I think market value is if I had to go use leverage available to me from banks today. But I'm willing to pay you your price if you give me a 4% interest rate, 10 years interest only, no principal payments whatsoever, and a balloon of 10 years. Does that work for you? And if they say yes, then I'm willing to pay a substantial amount just because I know how to use a financial calculator and amortization tables, right? So we have very creative ways to do this. We've done step-up rates where, we try to really destroy the principal on the front end by saying, hey, we're going to have a 15-year term, and every 4 years, the interest rate's going to go up by 3%, but I'm going to start at 0% interest. So in the first 8 years, I'm already almost halving my principal owed on this deal because I know how amortization works, right? Another thing that we've done for, call it more substantial value at any time that we have to get a major construction loan, no construction lender is willing to be in the second position, and most construction lenders won't even allow a second position behind them. So how do you get around that with creative deal structuring with a seller? Well, what you can do is move them from the debt side to the equity side. We'll say, hey, you come in on the deal as a JV partner, you contribute your property to the venture, and I'll make you a preferred equity partner, which means you get paid before everybody else except for the bank, right? And then I'm going to go to the bank, and the bank is going to allow me to use all the equity in that property as my down payment, which is going to juice my returns to the investors and to the seller who's now in a pref equity position. And that allows us to get the deal done at prices that wouldn't work if I had to use debt for the entire piece, right? Now all of a sudden I'm walking into a property where I have $3 million of equity just in the land alone instead of having to pay that $3 million out. And I can use that as a down payment towards the construction loan.
Look, we've been generally fans of the high interest rate world for a number of reasons. The biggest one that you touched on at the start is just, honestly, in a world without tailwinds, the cream does rise to the top. And then second of all, the biggest thing is just getting creative. And it's fascinating to hear some of the ways that you're getting creative in deal making. But the sad news is I don't think we have a lot more time today to talk about some of those creative tips, but we do have time for our final four. And this is one of the things on the podcast that we always love doing. It's our final four questions. It gives us a really good perspective on who we're talking to and kind of is a great way to round up the conversation. So the first question of our final four, and one of my favorites, is what do you think's changed the most about commercial real estate in general? And how do you see particularly your section of the commercial real estate world, self-storage, moving forward?
Yeah, so I touched on this a little bit before on the self-storage side. We're now seeing that self-storage is a sexy asset all of a sudden. After Time Magazine and Fortune started writing about it, now we have all this money chasing it. But a lot of that money is unwilling to do the dirty work. So there's a huge opportunity for aggregation in this business, especially if you know what you're doing and you have the operations to back it up. I think we're going to see a lot more creative financing in the next 5, even maybe 10 years, depending on what happens with interest rates. And then just the general appetite of this asset class coming out of the shadows and becoming more of a mainstream thing, where now instead of people talking about what stocks they bought over Thanksgiving dinner and GameStop and all this other kind of crap, they're going to say, "Hey, I got invested in a self-storage, either real estate investment trust or in a private syndication with Fernando, what have you." And I think that's going to help a lot of people beat that inflation trap that we're seeing occurring right now.
Look, I think there's always money to be made if you're willing to roll up your sleeves and get a little bit dirty. Um, I know that's always been our advantage. Moving is trying to go on smaller, dirtier assets. Um, but smaller, dirtier assets are great. But I think one of the most unique things about trying to find those smaller, dirty assets is trying to travel back and figure out how to get to those assets. So when
Right.
we're talking about traveling back in time, let's travel back to the start of your career. So when you were starting off, you're leaving high school. What's the career advice that you would have given a young Fernando? Uh, if you could have just had, a short 1 minute to give your 2 cents.
Yeah, I would have told a younger Fernanda to start bigger. There's only so much time that we have in this life to invest and to make money, and to start with these, $25 to $50,000 houses. It was almost a waste of my time. Looking back now, so what I probably would have told Fernando is go to a commercial real estate symposium, or you know one of these large events, conferences, and start walking around and seeing what opportunities are available to yourself. And then realize that you don't have to do everything on your own. So, real estate is a team sport. And even if you get into a huge deal, but only have 2 or 5% ownership of that deal, that's how you learn while making money. So you don't have to keep 100%. I'd rather have 1% of a watermelon than 100% of a grape.
Hey, that's been my life thus far, is slivers of a lot of big deals, and I would highly recommend that to anybody who's trying to dip their toe in the real estate water. Is get your hands dirty, get in on a big deal, and even if it's just a sliver, sometimes that sliver is all you need. In terms of trying to learn, and I know you talked about learning deals. Not everybody has the ability to reach out overnight, and maybe get to a symposium or meet somebody in the business. And one of the ways that I always like to recommend folks doing it is to reach out and learn a little bit about real estate or the business world through books. I've got a couple behind me. If you look on that wall, it's basically a wall of books. In terms of books, is there one or two books that you've read that have particularly influenced your career?
Absolutely. So the first is not really a real estate book specifically, but it's a book on running businesses, which real estate is a business. And that would be Traction by Gino Wickman. If you don't have an operating system for your business, then you're basically always being reactive and trying to put out fires, as opposed to being proactive and building your business and scaling as fast as possible. So that's one of the books I'd recommend. And then the second is also not technically a business book. It's a book on how to have tactical empathy, and that's Never Split the Difference by Chris Voss. Makes you a better partner, makes you a better I see it right there. Yeah, better negotiator. It makes you a better family member, a better friend. Those two books, I would say, if you're just starting out in the space, those two are going to pay many times over the cost in time and dollars.
Well, I have to read the first one, but Chris Voss is an excellent choice as well. In terms of the most important question we're going to ask you on the podcast, though, that comes right now, and the whole reason why we created the Real Finds podcast is to find out and identify key voices that are influencing the real estate world and influencing the whole world that we live in. Because real estate is fundamentally the way in which we interact with the world. And so, understanding that, is there a person that we should reach out to that's influenced your career or that you think is influencing the world right now?
Yeah, I have a good buddy. He is based out of Phoenix. He does self storage as well, but he has a kind of a different approach. He has more of like a Warren Buffett style approach, using a holdings company um, that they're completely vertically integrated. So they've bought the construction equipment company, they've bought the construction management company and the GC. They've bought the metal doors and dividers supplier as well, and that's been able to help them grow super fast. So it's a buddy of mine. His name is Andrew Abernathy. Um, the way he models his investments is very interesting. So instead of it being a traditional syndication where you have distributions and you have, cash flow and stuff like that, there's none of that in his structure. It's like buying shares of Berkshire Hathaway, right? So the value comes from the underlying assets and companies that you own, and every time there's an event where stocks are being sold, you have the option to sell out or not. May not be the best um, style of investment for some people out there, but for those that don't need the distributions to live on and are just looking to, maybe they have a retirement account or something like that is trying to put away value. Really interesting model that he created over at Abernathy Holdings.
Well, we have to reach out to Mr. Abernathy and see if we can learn a little bit about what he's doing down there in the Southwest. Um, so the second most important question we're going to ask you right now is, how do you reach out to Fernando and learn a little bit more? If somebody's in our audience or someone wants to invest, what's the best way to get in contact with you?
Yeah, so I can give you all the typical boilerplate answers, like go to our website, ssse.com. You can follow us on social media, self-storage syndicated equities or triple SE. You can follow me on social media, which is the storage stud. But what I find is that doesn't really help people reach out to me. So what I usually do, which is a little bit unorthodox, is I'll give you guys my cell phone number. This is my real cell phone number. If you text me or call me, I'll answer it pretty quickly. It's area code 630-408-8090. And the interesting thing is I have gone on over 100 podcasts. I've given away my cell phone number on everyone, and I still barely get one or two people reaching out every couple of weeks. So it's, be an action taker, reach out. If you want to learn more about our business or self-storage in general, I'm here at your disposal.
Fernando, thank you so much for hopping on the podcast today, and we have to have you on in the future.
Yeah, thanks for having me, Gordon.
Thanks again to Fernando. We appreciate his insights. And if you enjoyed the podcast, please give us a like, a 5-star rating, or review. Your comments, interactions, and subscriptions truly matter and help us continue to provide quality guests. You can follow us on YouTube, Spotify, or wherever you get your podcasts. I'm Gordon Lamphere at the Real Finds Podcast. Thank you for listening.